And we've got on board with us Mr. Vidyashankar Krishnan, the Vice Chairman and MD at Forgings, joining in on the show right now. Vidyashankar, hi, good morning, good to have you on the show. The Indian CV space has been a laggard with the overall sluggish automotive industry performance that we saw post FY19. In the current times, how well do you see the industry poised to rebound strongly and embark on a cyclical upturn, considering that we're still amidst the pandemic?
Post FY18, where the industry saw tremendous growth, riding on the back of a BS6 changeover looming ahead 1 to 2 years from that point, the axle load norms first, and also the I would say India becoming one unified country with highways, as well as the advent of GST. All these put together meant that India became, the CV market in India became very sluggish. There was excess supply. So this lasted for more than 2 years, and we've seen a very sluggish demand in the last couple of years. But what has happened is, with COVID coming in since last April, it has put further brake on this industry, particularly the recovery of this industry. So 2 years, we've almost had 2 seasons of COVID, Q1 of last year and Q1 of this fiscal. So we should see tremendous improvement in this sector. Most players see that the excess demand has been wiped away by the excess supply has been wiped away by the demand in the system, and therefore the CV market, I believe, is poised for growth. On top of this, we also have to factor in a significant growth ahead in GDP terms. Let's say we are now a $2.5 to $3 trillion economy, and in the next 4 or 5 years, we are surely headed to a $5 trillion economy. So I would say that the CV market is poised for real growth in the years to come.
To add to that, I also wanted to talk about the US Class 8 truck orders, because for the calendar year 21, they're estimated to, post a very strong growth. Do you see this demand sustaining for the rest of the year? And what then is the demand outlook for, outside India and the rest of the markets? How do you see the CV recovery cycle pan out over there? Because, each and every geography in that sense is at a very different stage in their fight against the pandemic.
Yeah, actually, the CV market in the US surprised all of us in June 2020. We saw a very strong June, last June. It's a year since the pandemic, and where we expected demand to really plummet and the CV market in the US to just wake up. But it started out with a bang after 2 months of shutdown, April and May of 2020. Since then, the CV market in the US has been on a roll. And pundits forecast that it will continue to be strong at least until, at least for a year from now. If not, till the end of 2023. So that's the demand forecast for the US heavy truck market. I've also been trying to fathom the reason for the growth, and I've been able to conclude that probably because consumers in the US aren't driving out to malls and buying their goods and are instead having their goods being delivered at home. So I presume that is driving the truck market in the US. Maybe there is a truck driver shortage, and therefore a little bit of less utilization of trucks in the US. But that's only conjecture from my side. So, but ultimately the market is doing very well at the moment, and this is expected to continue for the next 12 to 18 months.
How long before new supply kicks in, whether it's from you and from others? Because looking at this kind of a demand, an entrepreneur would say it's time to start investing again, right?
Yes, but we also understand that this industry is cyclical, and particularly if you look at it from Forgings' point of view, I would say that we have invested quite a bit in the last 6-7 years. Since fiscal 2016, we have invested close to 750 crores and we're still having some steam left in terms of completing our investments. So Forgings is well poised to take advantage of the boom in the CV market all over the world. Europe, on the other hand, has been chugging quietly ever since the pandemic, and even before that. There's not been any great dip nor any great growth, but it's been strong and moving pretty well. So amongst the large CV markets that we service, China, of course, we don't. I would say that India is lagging behind, and it is really time for the Indian CV market to perk up. I can't hear you.
How open are you to experimenting with this entire EV platform? Because it's a matter of time. Now, you may say 5, some may say 3, the consensus view is 7 years, that EV will be 10 to 25% of the total CV market. Do you have the ability to serve to the EV market?
See, the market is in an extreme state of, what shall I say, development, and it is a very nascent condition. So the market has to evolve before any of us can make a move on this and say that we will be in a position to take advantage, or we may not be able to take advantage of the move. So how this will evolve will be anybody's guess. The consensus that with whom we are talking with, people whom we are talking with, say that next 10 to 15 years, the CV market is likely to be in the current state of technology, with changes like buses, intra-metro operations of buses, and possibly LCVs, a portion of LCVs at least, going the EV way. But otherwise, the CV market is largely likely to be ICE bound. And we have to also factor in that hydrogen as a fuel is emerging very strong. I have been a great fan of hydrogen over the last few years, and I continue to hold that India, with its abundance of sunlight and a huge coastline, will be able to generate green hydrogen, and that hydrogen will be the fuel of the future. Not maybe in a fuel cell, maybe ideally for all of us in the automotive industry, in the form of a hybrid or a hydrogen internal combustion engine. Hydrogen internal combustion engine would be really ideal for the industry, but it's too early to guess. But hydrogen would be the way to go. EV backing on the availability of minerals, which are cornered by a few countries, will be a very tricky path forward. Hey, but this is all very nascent and subject to so much of development.
Your margins?
Sorry, I'm not able to hear you well.
Okay, your margins have improved significantly, and what should we...
Yeah, I can hear you.
If you can hear me, Mr. Krishnan, I was discussing your margins and how they've improved despite what we've seen on, inflation, commodity inflation. I was wondering how you managed to do that and what your outlook is going forward as well when it comes to the commodity price graph direction.
See, the commodity in our industry, particularly the forging sector, and most of automotive suppliers, is a pass-through to OEs. We simply cannot absorb any portion of the increase in commodities. So the increase in margins, I would attribute to a strong fourth quarter, so thereby leading to overall better sales and reasonable cost control at the manufacturing level. Plus, the fact that exports has been very strong for us. So that has also resulted in better margins. And we have considerably invested, as I told, a huge sum of 750 crores. It's the biggest investment streak that we've ever had. And so all that is added to our machining capability, which has added to the margins. But these margins are backed by heavy investment, so margins are essential to pay back the debt.
Okay, with the peak of the capex cycle behind us now as well, how does one see your utilization levels increasing? How would you compare it vis-a-vis what's currently there? And how can the capex that's already been done help in terms of growing numbers? Give us a sense of, what you're anticipating and whether or not you're also looking at further capex.
I think you asked a very nice question. See, last year we have achieved a production level of 46,000 tons on a baseline capacity of 100,000 tons. That's not any great shakes, but we have to factor that one quarter was effectively wiped out, and the second quarter was the world economy just started to wake up. Though America and Europe woke up with a bang. So if we extrapolate our performance in March to any particular year, we crossed a turnover of 100 crores in March alone. So that works out to a run rate of around 1,200 crores in terms of value itself. Plus, there is headroom for another 25% on that. On top of that, we have parts under development that would add to another 25%. So overall, we are poised for a lot of growth over March levels. The joker in the pack right now will be COVID, but I believe that with the strong vaccination program that we've gotten our act together as a society, will move forward. And in the next few months, between December and June of December of 2021 and June of 22, India will be well out of the danger zone as far as COVID is concerned. Of course, joker in the pack could be variants that totally disprove the vaccines. So looking at the volume side, we have looked at about 47,000 tons last year, and this year we are expecting, subject to the economy standing good, we are looking at about 60 plus 65,000 tons in this year, and in 2023. FY23 or FY24, we should be crossing the six-figure mark for the first time in the history of Forgings. This year, we are improving our capacity from 1 lakh tons to 120,000 tons.
Okay, Mr. Krishnan, great to have you on the show. Thanks for stopping by and highlighting quite candidly what the visibility for Forgings is going